Ever tried stuffing a week's worth of dirty laundry into a tiny gym bag? That's aggressive accounting, but with numbers instead of socks. It's the art of making your financial statements look better than they are. Think of it as giving your company a digital tummy tuck and a financial facelift, all without breaking most of the accounting rules. Let's be honest, sometimes the truth is ugly. Aggressive accounting? It's like that friend with the flattering Instagram filter always makes things look a bit rosier. But just like that friend's online persona, it's not always real. Now, we're not talking outright fraud here. That's a whole different level of messed up. We're talking about bending the rules, finding loopholes, and generally getting creative with how you present your financial information. Imagine this, you're selling lemonade. Business is booming, but you want to impress the investors, your mom. So what do? You start counting the lemons you haven't even squeezed yet as revenue. Congratulations, you've just dabbled in aggressive revenue recognition. Aggressive accounting is all about making things look better on paper. It's like using a really good push-up bra for your balance sheet. Companies can play fast and loose with when they record revenue, get creative with their expenses, and even invent imaginary friends, or assets. They might stretch the definition of an asset further than a yoga instructor on a retreat, or maybe they'll decide to forget to mention some minor liabilities like that pesky environmental lawsuit. Okay, before we grab our pitchforks, let's be fair. Aggressive accounting isn't always evil. Sometimes it's just aggressive. Companies might use it to smooth out earnings bumps, making their performance look more stable. And let's face it, a stable company is more likely to attract investors, borrow money, and generally keep the lights on. On the other hand, aggressive accounting can be a slippery slope. It's like that first white lie that snowballs into a full-blown avalanche of deception. When companies start playing too fast and loose with the rules, it erodes trust and can lead to some seriously bad financial hangovers. Remember Enron? Yeah, they took aggressive accounting to a whole new level. And spoiler alert, it didn't end well. The takeaway? A little aggressive accounting might be okay, like adding a sprinkle of sugar to your morning coffee. But too much, and you'll end up with a financial heart attack. Section 4. Spotting the shenanigans, red flags, and funny business. So how can you tell if a company's playing a little too loose with their accounting? Look out for things that just seem off, like a sudden, miraculous jump in profits. Or maybe their cash flow statement looks like it was written in invisible ink. Another red flag, when a company changes its accounting methods more often than a chameleon on a disco ball. It's not necessarily a bad sign, but it's worth taking a closer look. And if their financial statements read like a work of fiction, run far, far away. Remember, if it seems too good to be true, it probably is. Unless you're talking about free puppies. Those are always true. Section 5, the last laugh, why ethical accounting matters, even if it's less exciting. In the end, aggressive accounting might seem like a victimless crime. But the truth is, it hurts everyone. Investors make bad decisions, employees lose jobs, and the whole system starts to smell fishier than a seafood market. Sure, ethical accounting might not be as glamorous. It's like that reliable friend who always wears sensible shoes. Not that exciting, but they'll never leave you stranded. So the next time you're tempted to fudge the numbers, remember this. Honesty might not always be the most exciting policy, but it's definitely the best one for a good night's sleep. And in the world of finance, a clear conscience is worth more than all the cooked books in the world.